But the S&P and the NASDAQ, they're actually hitting new highs as we speak. The S&P up just over 0.75%. The NASDAQ moving higher, above 1% higher right now. Some big moves to the upside in just the past few minutes. But we're going to kick things off with our chart of the day. Of course, it's the 10-year. The yield ripping higher again right now. Take a look. It hit above 4.65 earlier in the session to touch its highest level in nearly 16 years. Right now at 4.6. And really, that's where we have to start this conversation, Shannon. Higher yields, but yet we're seeing a bit of a rally in the markets today. How's that even possible?
Well, because I think we've already been under so much pressure the last week or so, and not to say that that pressure has eased, because if you think about what we're facing right now, we're facing higher oil prices, higher yields,
right.
Potential shutdown. And
keep going.
Student loan repayments are back. We're in September, which is just a tough time in the marketplace. And so this continued pressure, I think, what you're seeing in today's marketplace is that you're looking at investors saying, okay, we've experienced some of this pain. We have had a pullback in August and September. The third quarter is not going to look as strong. But we still are looking at, over the next 3 months or so, what typically occurs after a tough September. And if you look at the numbers, the last 3 years, we've had a stronger fourth quarter after a weak September. And so there is some historical precedent, I think, for some of the optimism or enthusiasm that you're seeing in a few names today. I think our view is that coming into this year-end period, the confluence of all of these stressors coming at a time when seasonal weakness is already in the market and expected, that's why you're seeing this continued pressure. I think we're going to continue to see we're going to see some oscillation here. We're going to see some rotation, and at the end of the day, I think investors are still trying to figure out what is the right price, what is the right valuation at which I should be investing for 2024. Yeah,
also important to note the NASDAQ at 1.1% higher, highest of the day, but also the Russell neck and neck with it, Brenda, right now up over 1%. Generally, small caps are more interest rate sensitive. We're hitting 16-year highs. I mean, make sense of it.
Well, I think these small cap has really not participated at all in the rally that we've seen so far this year. And it's really incredibly cheap. If you're looking for something that's inexpensive relative to other parts of the market, small cap is it. Now, you could say it's cheap for a reason. It's because these companies do have to raise capital, whether it's through a secondary offering or through a bond offering or what have you. So there is some risk there, but you could also argue it's priced in. So we could be seeing some of that. And I think if we look at how that fourth quarter rally might play out, I could see some areas like small cap really starting to act better, especially if we see more trends within capital markets, more IPOs coming to market, more M&A activity. That should create a little bit of a valuation floor for some of those industries, particularly if we see some of that action within small cap.
So, Brenda, I want to make sure we're not leaving you out. One of the things that Shannon was talking about, all this wall of worry type of things, oil also back above $90 a barrel, down right now, down 0.75%, but still $3 above $90 a barrel. What do you make of the action that we're seeing in the market today? The NASDAQ up over 1% higher despite these higher yields.
Markets are really oversold, first of all. So looking at RSI, looking at all the stats, the market is oversold. If you look at SPY, the 200-day moving average is at 420. We're close to that, right? We're like 430 on SPY. So you've had a really decent sell-off. I think ultimately, though, when you're thinking about positioning over the next 3-6 months, I believe that we are now in a structurally different rate environment than we've been in the past 40 years. And so I still don't think that has made its way through the economy and potentially multiples, because we are a country of credit, whether you look at fiscal, look at corporations, look at individuals. And I think that the only reason that the economy continues to remain strong is the insane amount of fiscal stimulus that we continue to have. But ultimately, I do think that, like the Atlanta Fed GDP number, I think it's at 4.9. I just still think that's too high. I think that will continue to come down, because anytime you have to transact in the market, whether you're an individual buying a car, no one's buying houses, no one's buying existing houses, or you're a company having to go to the debt market, the cost of capital is exponentially higher than it's been the past 13 years. And so I do think rates matter. And so I think short term, the market's really oversold. You could see a pop here and some opportunity. But I think long term, we're going to continue to struggle with this new paradigm and this new regime of rate, which I do not think is going to go back to the way we were the last 10 years.
All right, Steve, agree, disagree? Will the market continue to struggle with this new paradigm?
Yeah, I think it will. I mean, what we're seeing today is a blip because you actually saw 10-year yields that were up coming down. So the algo traders, you know, the ARBs are in there just saying, hey, okay, let's buy it because, as Brenda points out on a technical look, short-term technical look, perhaps it is oversold. That, again, is just a blip.